Welcome back to the Mortgage Management Strategies. My name is Nelson Litsweni. I'm a certified financial planner. I'm the creator of this course. I am ready to go into the next section, which is the foreclosure clause. And I think and I hope that so far you have learned a lot and you're continuing to learn a lot about what are the important things to consider when you are trying to manage your mortgage and what are the things that you need to understand. I hope the previous lesson on installment, interest, capital was eye-opening and helping us to understand all the monies, the prices of the houses and the later pricing of the housing that you, when you want to sell, you want to be able to reach. Therefore, so right now we go to that very important foreclosure clause that gives a lot of power to the bank to take over your house should you breach the contract. Remember, all of this is not done with malice or with malicious intent. It is just in the contract, okay? I have said this before, that the bank, remember, the bank is a program. It is not a human being. And I will make more points with regard to that, even as we talk about the foreclosure or the later part of this course, especially in the fast tracking. It's absolutely important to understand that you are working with a program, and that program works the way it works. And it's important for you to understand that for you to do well in this thing is you need to understand that that process very, very well. So we are here now and we're talking about the foreclosure clause, which is in your contract. What is the foreclosure clause? What can the bank do? What power does the bank have? What power do you have under these circumstances, right? So now, the foreclosure clause is a clause that is in the mortgage contract. It empowers the bank to repossess and resell your house at the first sale value. Okay, I'm going to go into a little bit of details. I think I mentioned this before, what a first sale value is. And this only happens if there's a breach in terms of the mortgage contract. All right. So you breach, it gives them power to sell your house at the first sale value. Now, the first sale value is what is also referred to as the quick sale value. The quick sale value is not the same as the market value or the rebuild value. We spoke about a document in the beginning, which was the valuation report. In the valuation report, you will find these three values. There's three different values. There's the market value, which is that which sellers base their sale price on. It's the market value. But then, of course, there is what we call the rebuild value. The rebuild value is what the insurance company base their values on, because they say, should this house be destroyed, how much money will it take at this moment to rebuild it to its original state? So there is the rebuild value that is used by insurance companies. There is the market value that the seller wants to base their price on. And then there is the first sale value as part of that contract as well. The first sale value is the quick sale value, which means should the bank be under pressure to repossess your house, they are not going to look at the market price, which might be higher, or the rebuild value, which might be higher. They are going to look at the first sale value. Now, the original first sale value is not necessarily going to apply at this time. So that's why the valuation report, most banks would make them every 5 years. They would ask you, let's revalue your house. Let's revalue your house. And at any given point, they get to determine, because all these three values are also somehow related. Market value, rebuild value, and the first sale value is the quick sale value, which means we can sell this thing really, really quickly. It is very likely below the market value. It is more aligned to the balance, how much you still owe the bank. All right. And the bank just wants to get that which you owe them. And so the first sale value is not necessarily what you owe the bank, but it is what the valuers would determine as should they be forced to sell this, the quick sale. This could be sold really, really fast because it will be below the market value. So we talked in the previous section about the interest, what you have paid, the capital, and what you owe. So that balance, what that you owe, now if you have rebonded the house over and over again and you owe a whole lot more, it is not necessarily true that the for sale value will be close to what you owe, because if, say, after your 9th year you revalue the house and you take extra money out, the equity out, which we'll talk about in the bonus section of this course, what the equity release is all about. We'll talk about that. But if you have taken another mortgage on the house, the for sale value will not necessarily be equal to what you owe. You could be owing a whole lot more than the quick sale value. So it's also that legal document that you need to understand, because a lot of things are based on that, is the valuation report. So when we talk about the foreclosure clause, we're talking about a combination of a number of things and the actions that the bank can take based on certain documents that you've already submitted or will be submitted at the point of stress. And the point of stress is when the bank wants to repossess because you have breached the contract. So the breach is a stress point over here. And in the next lesson, where we talk about the risk period, we can understand what the stress points are all about, that you need to be able to manage as well. So a foreclosure clause is there. It's in your contract. It gives the bank the power to sell your house at the for sale value price if there's a breach in the contract. And they will always tell you the fact that we are not doing it now doesn't mean that we are foregoing our right to do it. Sometimes you'll find an understanding banker who's willing to work with you a little bit, but even that banker has limitations because the bank is a program, and the program doesn't have those kind of sympathies that you might expect. And we'll talk more about that when we talk about the fast tracking principles that you need to be able to follow. So now, the foreclosure clause, the question we have to ask ourselves, under what circumstances would the bank trigger the foreclosure clause? I've already alluded to the stress points, okay? The breach in the contract. What is the most likely breach you are going to have is missed installments. Because when you miss, you are breaching the contract. So missed installment for a period stated in the contract. Now, it doesn't even have to be these. We say usually 3 to 6 months. They could say, one miss. Obviously one miss is a breach, but sometimes they will wait and say, okay, you missed once, you missed twice, you missed 3 times. Chances are you're gonna miss the 4th time. We are taking the next action. So one miss is already a breach. Okay, you are in breach of your contract if you don't pay that. But sometimes they will wait 3, with a little bit of understanding, 2, 3, 4, up to 6 months consecutively. So it could be that you are in arrears 3 to 6 months consecutively, or you have billed arrears equal to 3 to 6 months, which means you have 3 months arrears, but it didn't happen consecutively. Maybe this year you missed once, then next year you missed twice. Okay, at the end of the 3rd year, they're like, you have 3 missed installments that you haven't made good on. Therefore, you are definitely in breach. And if you are in breach of the contract, the bank has the power to trigger the foreclosure clause. All right. And remember, they'll always tell you the fact that we are not doing it immediately doesn't mean we are giving up our right to do so. So the breach that may trigger this is nothing but the missed installments. And sometimes people confuse their relationship with the bank or the fact that they've been with the bank for 10 years or 20 years to say 3 months is nothing. This is where you have to remember that the bank is a program. We're talking about a banking program that functions on one miss equals this, second miss equals that, third miss I do this. All right, so you might go to the bank to see someone who works at the bank and think that they can go and override the program, and they might tell you, I don't even know who wrote the program. All right, I just work for the program. So you must understand that a missed installment is already a breach. One missed installment is a breach of the contract, and as soon as you breach the contract, the bank can pull the foreclosure clause right there for you. So what would it mean for you? Okay, there's a dispute. A dispute would be declared. Okay, they will talk to you. Now, the banking program, it's not like they will immediately run to court. More often than not, they don't necessarily immediately run to court. They'll work with you and say, okay, you have missed, can you make good on it? And maybe you make good on it, and you miss again, and maybe you have built up arrears for 4 months, and the collections department of the bank has been in contact with you, and still you are not making good on your promises, and maybe you make a repayment plan and then they work with you. But once the credit control takes that contract and gives it to the legal department of the bank is not very likely to call you. Once it leaves the collection, the credit control department, which collects money from you. Once it goes to the legal department, they might say, look, we have worked with this person and they are just not making good on it. Do the legal thing. And once it gets to the legal department, they focus on what breaches you have made, and so then they will go to court. So it's not an immediate, you've missed, therefore we are taking over the house. They need the court to adjudicate because there's a dispute. And in the contract, you will see a clause that says, in the case of a dispute, this matter will be settled in the court of blah, blah, blah. This country, this state, this whatever. It's written in there. And so they'll be able to take you to that court and get a judgment against you. Now, getting a judgment against you doesn't necessarily mean they will act on it. It just gives them power. They have a judgment. They can still come back to you and say, we have a judgment against you. Are you still willing to work with us? Or should we take this judgment and give it to the sheriff to implement it? Okay? So if you don't work with them, even if they have a court judgment, if you find a compassionate bank manager, they might still hold on and say, please work with us. We have a court judgment against you. And if you don't, then they hand it over, leaves their hands, goes to the sheriff. Now, the sheriff is the one who's just going to implement what the court has said. Okay? And they are the messenger of the court to implement that. So it's way out now. It's gone too far, and they're going to be in the process of repossessing your property once it's in the hands of the sheriff. Now, the sheriff is the one who's going to sell at the first sale value. Now, be aware that it can also be auctioned with or without the reserve price. Sometimes the sheriff will say, okay, I'm going to sell this at auction, but at auction, I am setting a minimum price to be, that which you owe the bank or a little bit more or whatever. But depending on what's going on, market conditions are always changing at all times when we are dealing with these things over here. Okay, so it can be auctioned with or without the reserve price. So if it's auctioned without the reserve price, that means the highest bidder, whatever it may be, whether it is equal to the amount you owe or less than the amount that you owe, if there is no reserve price on it and you still owe 391,000, but the highest bidder is 100,000 and the sheriff is just intent on getting rid of it at that time, then 100,000 is what will be collected, and then the balance is what you will continue to owe. So after sale at auction or however way they've done it, if the remaining debt is higher than the sale price, you still owe the bank. So if at auction it fetches 100,000 and you owe 300,000, that means you still owe the bank 200, and they can go after your other assets other than this house. Okay, so that's what you must understand, that in that contract it will be clear that you owe us, and what you owe us is not limited to this house only. It could be your other houses, your cars, your other properties. They are game until they collect every single thing that is owed to them. And of course, if the sale price is higher than the debt, yeah, they'll give you the balance. All right. So there are no guarantees. Once you are at this point of breach, you must understand that the power is shifted from your side to the side of the bank. And so it is very, very important in the next part of this course to understand, how do you stay one step ahead of the bank? How do we get to avoid this position? Because this is a position of no return. When we look at your risk period, we will look into all elements that are necessary for you to stay one step ahead of the bank. But you can't stay one step ahead of the bank unless you understand this very thing that I call your risk period. And we're going to spend some time in lesson 4 working with that. So in terms of the foreclosure clause, understand what it is, okay? It is a power of the bank to take over your house and sell it at the forced sale value because there was a breach on your part. And you must understand that this contract is a contract on its own. It is not based on your relationship, the rest of your relationship with the bank. You can't say to the bank, but I have been banking with you for 20 years and therefore you must have mercy. This contract is on its own contract. So it is not based on any other thing, any other relationship. I often tell people that the bank doesn't have a 20-year memory. It only has a 3 months memory, because it only figures out what happened in the past 3 months. And by bank, I mean the program. The banking program says you have missed installment for 3 months, you are in breach. In fact, you are in breach after missing one installment, but sometimes the mercy is built into that. They will wait until you miss the 3 months. But don't think because you've missed one, you are not in breach. You missed one because you signed that you will pay every month. Sometimes you are in breach because you were late. You said you will pay on the 20th. You paid on the 22nd. The program is going to say you are in breach. Okay. Contact with the bank, whether the employees are changing and there are new employees when people are moving. Okay. So you have a relationship with the bank for 20 years, but the employees don't necessarily stick around there for 20 years. So as soon as the one who's managing your account leaves and you meet and there's a new person, go and meet them, get to know them, so that, they can alert you and say, hey, we tried to collect and nothing came through. You are in breach. Can you come and, do that, pay by hand or something, because we put a debit order and nothing came through. So always have a relationship with your banker. That is the way to work with this for 20 years. Don't get tired, and always be aware. Is my banker still, the human being behind the bank, behind my account, is it still the same one, or have they moved my account to someone else? Sometimes they sell these things to other people. If you remember the 2008, 2009 banking problems that we had around the world, it's mortgages like these that were sold to third parties, and therefore you didn't owe the bank anymore because they sold your account to a third party and you owe the third party. So if you are aware of what is going on with all of these things, and that will also be in the contract, that we can sell this thing. Okay, if the bank wants its money right now, they can sell it to a third party who clears it off for the bank, and now you owe that third party, and you might not even have a relationship with that third party. So understand the game is bigger than just that. That contract is not thick for nothing. Those terms, you will find them in there, that the bank has a right to sell this to a third party. The bank, there's so much that can happen. The banks can get taken over, the banks can move, and they move with your account and all of that stuff. All that can happen. You must remember to stay alert at all time. So this is basically what we are talking about when we talk about foreclosure. We're talking about something working against you because of the one little thing called a breach. You've made a breach. in the contract. So we're gonna go now look into risk period. My name is Nelson Letsweni. I'm so glad that you are here with us. I hope you are learning a lot more. And in the next one, which I have said in the beginning, that it is a key, it is important, risk period. That's what we're gonna do in lesson 4. Thank you very much. See you in lesson 4.